Okay, so it is recording. Actually, now you may not actually have time to go back home tonight and listen to me again for another 2 hours. I don't recommend you do that. What you can do is you see that there is a little counter, the timer there. So if at a certain part you think you couldn't understand or it's a little bit complicated, you just mark down the time. And then when you go back home, you can just scroll forward to that part and you just listen to that part. That would be my recommendation, okay? Unless you really want to hear the whole thing. Okay, so I want to welcome everyone for coming. I think this morning's session would be very useful for all of you. And I also think the presentations that we just heard just now, they are absolutely relevant to what we are going to discuss. And I'll come back to some of the points again, but first up, so before I forget, so in a moment, I am going to explain so just that I don't forget, I will explain to you the difference, or I'll explain to you what is premium redemption. I'll come to that, which is actually related to the presentation that Eric just made. I will also explain to you the difference between a CB and an EB and a stock option and a warrant. Now, so we'll come to that. So probably some of you are wondering what these are. This is how I would like to do it. So there are some topics that I have prepared some notes. The best way might be for me just to go direct to your questions and answer your questions. And then if I need to refer back to the notes, I will. But otherwise, the notes are there for you to see. Now this, so this tutorial file is already online, and I have started actually collecting all the YouTube links. So when you click on these, then you can see what we talked about last time if you want to. Okay. So on green shoe, so it's actually a combination of 3 different segments that I have put together. And then the tutorial for last week, this is just a Q&A for that. And then structural versus contractual subordination, if you want to go back and review that part, okay? So next lecture will be next Saturday with Chris Lee now. And the next tutorial, I think I will run these tutorials and I will share with you, but I may actually make it voluntary. Okay? Bless you. So if you really want to take a break, feel free to do that. And I might just send out a little survey between now and next week to see who wants to come. And if absolutely nobody wants to come, then we'll all just take a day off. Okay? Don't feel you have to come. We're going to discuss those articles, as I said, and I will also prepare you better for Chris Lee when he arrives. Okay. So on that. Now, I've said this like 5,000 times. For Chris Lee, you have to come to the right class, please. So if you're from A, if you're from class A, please don't go to class B. Please do not do that. There's going to be a seating plan. we are going to assign you to working groups. So if you are from the wrong class, there is not even a seat for you. Okay? So starting in January 28, which is around 2 weeks from today, and then for the 4 weeks starting there, every week we are going to have 2 topics, and we're going to have 2 working groups actually presenting every week. Okay, now I will just to be efficient, I will just split you guys up and I will post a list online so you know what group you belong to. So over 4 weeks, there will be 8 presentations. Okay, it is quite substantial, so there is a chance for everyone to talk. Okay, and then so please dress for the presentation properly. Okay, so lectures starting next week. Okay, now you need to actually collect some cases. If you're wondering what are the cases, you go to the course outline, they're all in there, okay? And I will let you know which 2 teams will be presenting the first round. It's random. It's not going to be team 1, 2, 3, 4, 5, 6, 7, 8. So we want to be fair to everybody. So every team will get around 2 weeks to prepare, okay? There is a quiz on that, which normally I think happens at the beginning, and then the presentation itself is 10%. Okay. There are 5 quizzes, so I think Chris Lee actually will give you a quiz even during the first week. Okay. So there are 5 quizzes. There's no final exam, as I've told you. Okay, so that's it. He likes people to have name tags. Okay, so there will be a seating plan. He really wants to get to know you. Okay, so that's on the logistics. Now, let me jump to today's the main section. Continue. All right, so now let me, once again, I am very grateful for all of you who wrote to me with your questions, and I'm going to try and answer those in the next 2 hours. So let me just very quickly run by you what are in the slides, okay? So I have a quick recap on what convertible bonds actually are. So we'll go through that later on. So how do hedge funds actually invest in CBs? I think unless you have an understanding of this, you don't completely understand why there's all this talk about providing short selling and this and that. So we'll come to that in a moment, okay? What is a call spread? We kind of touched on that too. So we'll try and review that in the course of answering your questions, okay? What is an equity swap? So this is related to the country garden trade, which I have tried to dissect and analyze with some detail. So this is just the concept itself of equity swap. We then look at the country garden, which really was a pretty classic transaction. So I've got some notes here, so we can go through that. Now, then there's a list of concept checks. Okay. Now, this is by no means a complete list. It is not. But if you were to go through these topics that I have listed here, and if you are able to ask yourself these questions and you are comfortable answering them, I honestly think you can't fail. Okay, that's what I can say. But this is not a complete list, and I'm not saying these questions are in the exam. I'm not. Okay, this is just what you should do. So that's for equity. That is, there's another one for follow-on offer. So there's a list of things for you to think about. There are some sort of review questions. Okay, debt markets, same thing. Some no. Well, I don't have review questions here, but it's okay. So you just look at these. Equity link, again, some questions. Now, I don't have questions for the RMB internationalization because it is quite a straightforward topic, and mostly you just need to keep yourself informed. Okay, so you can just go straight there and look at the material. It's quite comprehensive. Okay, let me grab some questions right away. Okay, and this is the first one. So, dear Sam, I have a question regarding. By the way, I gave participation points to all the people who wrote to me, so thank you for that. Okay. I have a question regarding bond issuance. I know that bond price goes up when interest rates go down and vice versa. That is true. It's inverse. So corporates will most likely issue bonds when interest rate is low. Well, I guess yes, that's better. Or they issue bonds when they need money. So my question is, what exactly is that interest rate? Is it the bank interest rate, government bond interest rate, or the rate of the market where the corporate is in? It's the last one. Okay. So for those of you who are not from a fixed income background, or even if you are doing fixed income, there are different types of yield curves, as you know. So this is time, this is yield. So first of all, there is a government yield curve. So if you're in the US, we are talking US government. If you're in China, we're talking Chinese government bonds. So this one is always, well, not always, but it's supposed to be risk-free, and it's supposed to be the highest quality. There are instances when it is possible for a corporation to have a higher credit quality than governments, but apart from that, apart from those exceptions, so there's a government yield curve, and then let's take so all the way out to 30 years, let's say. Okay, now let's take IBM as an example. Okay, so IBM has a lot of bonds out there that you can find on Bloomberg. Now, if you look hard enough, you probably find that for big companies like IBM or General Motors, they also have a yield curve. Not every company will have a yield curve. If you don't issue bonds, you don't have a yield curve because you don't have anything trading. Okay, but let's say you have issued lots and lots of bonds, then you will have a yield curve, and you may have like a 30-year point, and maybe you have issued a 2-year bond, and maybe you have issued a 10-year bond, let's just say, okay, and then the way people will price your bonds are based on, of course, the yield of the government and the credit spread. This is called a credit spread, or the corporate credit spread, if you like. Now, so both of these can change. As far as the government is concerned, it is changing right as we speak, even now. U.S. Treasuries are trading 24 hours a day. So this one can change, and this one also can change. So this person is right to say that corporates like to issue when interest rates are low. What interest rates? Well, I think it's the whole thing. But as you can see, because the whole thing is driven by two components, so when either of them is very, very low, it will help. And of course, for government, okay, that is a major driver that drives everything to a great extent. You may have, a very wide credit spread. Well, as a company, okay, well, I'm sorry, that's your problem, okay. But some other company, which is very well organized, they may have a very tight credit spread. Now, the government cannot control everything. What they can control is the government yield. Or, well, I mean, it's not true they can't control that, but they have some influence on that. Okay, control is not the right word. They have some influence on that in terms of how much they issue, in terms of the general economic conditions of the country, and also the central bank has some influence on that. All of those things. Okay, so it is the interest rate of the market where the corporate belongs to. But even if that was the case, it is also influenced by the government bond yields or the government bond market. Is everyone okay with that? Yeah? This is more like a fixed income kind of question. Okay, so question number 2. Dear Sam, good afternoon. I am writing to ask you several questions about capital markets. What exactly is an equity swap? In the case about the Country Garden and Merrill Lynch, that Ms. K refers to, it's Professor K for you. Okay. Why is Country Garden the long position and Merrill Lynch the short position? I'm quite confused how the deal is set and how it runs. What is the difference between a convertible bond and an exchangeable bond? I Googled about them and found they're all bonds in exchange of equity, and I want to know more about them. Third question. On page 24, lecture 4 notes, it said cash settlement can give balance sheet flexibility. What does BS flexibility mean? How does it work? I think I want to tackle questions 2 and 3 first, and I'll come back to 1 in a moment. Okay. Now, so for question 2, the easiest way to understand is, and this goes back to question 2 is this one. Okay. Now, so if you are, this is how I like to look at it. So there are a lot of equity-linked products out there, equity-linked. I would like to divide them into, well, I'll call them bond-based or issuance-based. Okay, now this is not an official definition. This is just me or standalone. Okay, now you won't find such definitions out there. The definitions are not important. It's how you understand the products that's important. Okay, you ask 10 persons, you're going to get 8 different definitions. Now, bond-based, there is CB, there is EB. Now, first of all, what's bond-based? You got to pay for it. You pay $100, okay, and you get the bond. So CB would be something like So an example of that is Country Garden, obviously. So when a company issues a bond which is exchangeable for, I shouldn't say exchangeable, convertible into the shares of its own company. So another example, of course, is Microsoft, that zero coupon thing that was issued, and we share the news story with you. Now, an EB is a little bit different, okay? So it's issued by A, issuer is A. In fact, a better example is Temasek. So again, these are this transaction was one of the case studies that we uploaded for you to read. So Temasek was the issuer, but the shares actually were for the shares of Li and Feng. So you can actually do that. You issue a bond where you are the borrower, but it converts into the shares of somebody else. In fact, we had a presentation just now, that one with Postal Savings Bank, I think it was, okay? Is everyone okay with that? Yeah? There are lots of transactions like this. I think the purpose of doing an EB is quite different. So CB mostly is because you need to borrow money and you need funds, and your preferred avenue is the convertible bond. But for the EB, usually the issuer actually, they have those shares. And the best place to look for that is the Temasek transaction. I always remember that. So they already had an investment in Li and Feng shares, and they want to issue a bond, which is an EB, okay? Now, when they do that, so at maturity, one of two things will happen. Either there is no conversion, in which case they just pay back the bond principal, and what it means is they borrow some money at a much lower interest rate. In fact, what was the interest rate for Temasek? Does anyone know? It was very low, extremely low. In fact, it was zero, right? So they don't have to pay anything. So I'll tell you more about that in a moment. So either, number one, you pay back the money. That's fantastic, isn't it? Okay, you don't even pay to borrow. Or number two, people will come to you and ask for you to deliver shares, but the strike price was higher, substantially higher. So basically that means you get to sell your Li and Feng shares at a much better price than where the market was trading at the time. Okay, now everyone is okay? Okay, now then you have standalone means you just trade the option. Trade the option, or in this case, we are talking the equity option. Now, one very simple way to trade stock option is you go to an exchange. So, you know, anytime you could go to the Hong Kong Stock Exchange or New York Stock Exchange, there are options there that you can buy or sell. When you do that, it is actually similar to trading the futures contract, which means when you buy something, there is actually a seller somewhere on the other side. You don't know who it is and you don't care, okay, because it's done through an exchange. That's one way. Okay. A warrant is actually when there is an issuer, such as one of the transactions that you saw earlier, RTSE or whoever it was, I forgot. Okay, so it's issued by a company. So in fact, you can even, now the Hong Kong market used to be quite active for warrants, so they can actually be for, investment purposes. So, companies like UBS and Merrill Lynch, Macquarie, they would issue warrants, and then you can trade them in the stock exchange, but there is a specific issuer. There is an issuer. So your risk or your claim is against that issuer, which is different from when you are trading stock options just out there in the market. Okay. Now there are even like employee stock options, although this is a rather narrow market, but this would also fall under. Now, this is not the only hierarchy. There are other ways to look at it, but I think so I'm not saying you might find somewhere else in other textbooks that they take a different approach. Okay, that's fine. I don't have a problem with that, but I'm just trying to tell you, how can I shrink this? Cannot shrink it. Okay, I think I have shrunk it. This is one way to look at it. Okay? Everyone is okay with that? So I think I have answered question 2. Now, on page 24, lecture 4, it says cash settlement can give balance sheet flexibility. What does BS flexibility? You got to be careful using BS, because BS sometimes stands for bullshit. So I try not to say that too often. Okay. What does your BS look like? What? Your balance sheet. What was that? Lecture 4? Lecture 4, page 24. So lecture 4, page 24. Okay, so cash settlement, cash value. Okay, I get it. Now this is the page. Okay. Now when you issue a CB, so like I said, at maturity, just imagine that. So your issue price was 100, but at maturity, and let's say it can be converted into 10 shares. Just keeping it simple. Okay, so your strike price is $10 per share. $10 per share. And let's just say at maturity, the share price is now $14. All right, just imagine that. Everyone is okay so far? So if you have that bond, basically that piece of paper at maturity is going to be worth how much? $140. Yeah? Now, would you convert? You bet. If you don't convert, then legally, if you choose not to convert, which would be a crazy thing to do, or if you forget, okay, guess what? They just pay you back $100. Okay? So you have to actually tell them, yes, I want to convert, please. I think 3 years ago, there was one student, who did a presentation on CB. I don't know if you're aware of that, and you might even be able to find that transaction. He said this was way back, 3 years is a long time. There was one trade in China, a CB trade, where at maturity, some investors forgot to convert. And too bad, okay? You just get back your par value. Okay, you haven't lost anything, but you're not really helping yourself. But anyway, so here, so physical settlement, well, that's very simple. So the investor simply will give you back the bond, all right? And you will give them 10 shares. That's physical settlement. Now, like I said, this is actually worth $140 now, isn't it? Yeah. Now, the other way, cash settlement, is simply this. So you are the issuer. Guess what happens this time? So the investor is here. So they surrender the bond, and instead of giving you 10 shares, they will give you back your par value, and they will give you back your profit. Now, I write them separately on purpose, but you can see that it's still 140, okay? The cash settlement, I guess it relates to this element here. So we just pay you back your profit. We don't give you the shares. Now, the economic result seems to be the same. And I think for the investor, what they can do, if they want, they just turn around and they go to the market and buy the shares if they really want to. Okay? Conversely, for the first case, you actually can turn around and sell the shares if you really want to. Okay. Now, for the issuer, what is the difference? Well, I'll tell you what the difference is. Here, you really have to issue the extra shares. Quite often, issuers don't like doing that because it would dilute their equity base. Issuing more shares is something that a company never wants to do without thinking seriously, okay? No one likes dilution, honestly. So here, all right, well, that means I physically have to get $40 from my wallet and pay you. That's the bad part. The good part is there are no new shares in the market, okay? So you just weigh up the pros and cons and decide which one you want to do, okay? So cash settlement is not the answer to everything, okay, but it does help you avoid the dilution problem. Is everyone okay with that? Yeah? So if you don't need to issue new shares, it does make it more flexible. So you are not constrained in fact, you probably can, near maturity, you probably can even talk to those investors in private. You can tell them, hey, look, I know this CB is cash settled. Just imagine that scenario. We know it's cash settled. You can talk to some investors selectively, but would you like to get some shares, for example? If you do, maybe we can arrange some kind of follow-on offering. So you have that flexibility, okay? I'm not saying you would, but you can, okay? So that's why it is more flexible. Or maybe you just don't do that. Just pay them cash and forget about it, okay? Now, country garden, I'll come to that later on. I'll explain that in full, okay? So let's go to part 3. 4, 5, 6, 7. Okay, so after we do part 3, we'll take a short break, and then we can take attendance as well. Okay, so sorry to bother you. Actually, I have several questions. I'm a bit confused with the conversion ratio and the parity. If I didn't understand wrong, it was taught in class. The conversion ratio is an issue. Okay, you just read it as I read it. Okay. It's the issue size divided by the conversion price, and the parity is the percentage. I wonder which are right and which should we use in midterm. Now, don't worry about the midterm, okay? It's not the midterm, it's which one you should use when you talk to professionals out there. Can you please explain page 12 and 13 from lecture 4? What does poison pill mean? Poison pill is a term that applies to, is a kind of corporate defense mechanism whereby when you have liabilities, you try to insert certain conditions which makes it very hard for someone to take over your company. Okay, for example, you can issue a bond and you put in there what we call a change of control clause, okay, which will say something like, if the control of this company changes, we will pay you back your par value of this bond immediately. Let's say you do that, okay? So that means if someone takes over that company, immediately they need a lot of cash because they know the lender can claim on that bond. So that is an example of a poison pill, okay? On page 40, we see the dividend pass-through structure is to stabilize option value by adjusting the strike price. I think it's beneficial for the investor because it prevents option value from decreasing every time the company issues a dividend. But why notes say it's better pricing terms for the issuer? Okay, I can explain that. Can you please share more on basis risks related to CNH, CNY market, and some about window guidance? Window guidance. Okay, let me start with, so paragraph 1. All right, now, so parity and conversion ratio. Unfortunately, conversion ratio is not really a ratio. I think that's why conversion ratio is this. Now, always think in terms of 100. If that is the par value or face value, your face value can be 1,000 quite often, but let's just say 100, okay? Conversion ratio is simply how many shares one bond will convert to. Now, sometimes you can use a face value. If you use a face value of 100 and the strike price was 25, then your conversion ratio is 4. Because one bond, no dollar sign, one bond can convert to 4 shares, okay? It is simply that. That is the conversion ratio, okay? So it's not actually a ratio, unfortunately, okay? So let's say your share price now is 20, okay? And so this hasn't changed, okay? But the share price now is 20. Now, what am I saying? The other term, parity, yeah, so first of all, let's say your share price now is actually is 20. Okay, then this thing called a conversion premium is simply 25 divided by 20, okay, which is 120%, or 20% if you want, okay. Now, there's another definition, so this is the conversion ratio. Parity, so let's say the stock price started at 20 and the stock price is now at 45. Okay, so there's a huge jump. So parity is simply a calculation of if you were to convert now, right now, how much is that worth? Now, if you convert right now, your bond can convert to 4 shares, so that value would actually be $180, okay? So parity is simply just this value here, okay, or 180%. Okay? Everyone is okay with that? Yeah? So conversion ratio and parity. Can you please explain page 12 and 13 of the 4th lecture note? So page 12 and 13. When does issuance of a convertible bond make sense? Okay, this might be in 13. Now, this might be a good moment to actually go back a bit, because I have prepared some notes regarding how a convertible bond actually works. And now, a convertible bond, let me try and wipe out all this stuff here. So a convertible bond, you can think of it simply as a bond plus a call option. But the thing about finance is the concept might be very, very simple, but when you take it apart, it is quite amazing often how much creativity you can have even with a simple concept. So it's just a bond plus a call option, and compared to a normal bond, a convertible bond will pay a lower coupon. because you are compensated by the call option, okay? And the strike is normally higher than the current price, except in the Chinese market, as I said to you, okay, where it is quite often at the money. COCOs, we already discussed that. There is another kind called contingent convertible, sorry, convertible, contingent convertible, but we won't go into that, okay? Don't worry too much about the COCOs or how it's priced. Now, this is actually the table that Rose provided to you, but I have populated it. I populated it with the trends and also my explanation, okay? Let me just very quickly share with you how the CB actually works. Now, imagine there's a company X, okay, and they want to issue a plain vanilla, not CB, just plain vanilla bond, okay, and for 5 years. And let's say the yield is normally 5% for 5 years, okay? Just say 3 years, doesn't matter, okay? So what that means is for this company, if they were to issue just a normal plain vanilla bond, this is what they'll be doing. So a 5% coupon every year. Now this is a plain vanilla bond, okay? No calls, no puts, nothing. This is what they do. And then at the end, 100. Now, what can happen is for the same company, I want to make this a little bit smaller. How can I do that? View, okay. For the same company, what they can do is they tell the investor, well, look, instead of issuing a bond where I pay you 5%, now I don't pay you 5%. So let's say I pay you 3% instead. So the investors will ask, well, where's the other 2% gone? The other 2%, you can take the present value of that, which will be approximately, let's say $5.50. It wouldn't be $6. You don't just multiply by 3. So the present value of that, I'm going to give you a call option on that instead. Okay? Is everyone okay? That is the simplest way I can think of to explain a convertible bond. So this is the call option that is yours to exercise if you want to. Okay? Now, of course, the price of this call option is driven by a number of things. So it's driven by the company's share price at any time, of course. It is also driven by interest rate. It's driven by interest rates. And by that I mean, and this is related to the first question. So, the government yields, that the risk-free rate. It's also driven by the corporate credit spread of the issuer, because these two will make up the bond yields of that company. Whether you have a call option or not, it's still actually a bond. It's a little bit like Lego, okay? You have a Lego in front of you, and you're wondering, what is it actually made of? Well, you can take it apart and look at the bits one by one. That's what I'm doing here, okay? Now, the last thing is the stock volatility. Because you have a stock option, an option is priced mostly by volatility. Now, in fact, if you look at it like this, all the elements, all of them, okay, there is a way to hedge these. Now, how would you hedge the stock price? Well, you can simply short sell if there is a market for it. Okay, I'm not going to talk about what short selling is. Now, here, if you want to hedge general interest rates, okay, there is the government bond market, or even bond futures. So you can hedge that part. Now, how do you hedge the corporate credit spread? Well, you can use credit default swaps or asset swaps to do that. Now, how would you hedge this one? Well, this one is a little bit harder, and this is not a trading course, okay? So I won't go into a lot of details, but if you really, really want to hedge this, you know, one way is just to sell call options, okay? But I don't think you need to worry about that, because if you buy a CB and you end up hedging everything, what is the point of buying a CB, okay? You want to have some exposure. Now, furthermore, so I drew this diagram, okay? Now, there are different ways to play this. I'll show you two ways, okay? Number one is you tell the investor, well, I know that normally I need to pay you 5%, and now I don't pay you 5%. In fact, I'm going to pay you 0. And the investor will say, you're kidding me. Okay, you don't pay me anything until maturity. But then they will say, okay, instead of paying you a coupon, I'm going to give you a very, very attractive call option. So the terms will be a lot better. For example, it will have a much lower strike. In fact, that's kind of what you can offer to them. Okay, it will have a lower strike. So that's one way to play it. The other way you can play it is, and this actually is related to Eric's presentation. That's why I asked him what was the redemption price. The other way is you tell the investors, well, all right, I will pay you 3% coupon. So the other 2%, we use that to buy the call option. But I don't pay you the 3% every year. I don't do that. At maturity, I'm going to pay you 110 if you don't convert. If you do convert, you are basically surrendering your 110 in exchange for whatever shares you are getting. So the conversion premium is slightly different. Okay, now this is actually, you know what this is called? This is called a premium redemption structure. When the redemption is not at par, but it's actually above par. And this is exactly the transaction that Eric actually brought to us when he was presenting. Okay? Is everyone okay with that? Sorry, I know this morning is heavy. Let me go to. Have I answered all the questions? So I've answered this one. I answered this one. I answered this one. Dividend pass through. Why is it better pricing terms for the issuer? Okay, now, first of all, what is dividend pass through? Let me see if I can explain that to you in 2 minutes. I pretend you are my client, okay? No, better, I pretend you are my boss. So I will draw your attention to, first of all, optionprice.com. It's my favorite website. Now, this is pricing a very simple option here of $100 stock price. Strike is 100. I'll make it 1 year just to make it interesting. And don't worry too much about the interest rate. But dividend yield is 1% right now. Now this option will cost you $9.40 if it was a call. Now watch what happens now if I change the dividend yield to 2. I'll change it to 5, okay, so it goes up. What happens to the call price? Up or down? Very good. Call price goes down. The reason for that is, well, as you know well from your derivative markets classes, when the dividend goes up, the stock price comes down. No one has lost money, okay? It's just, if this company is worth $10 now, I pay you $1, then how much is this company worth? It's worth $9. The stock price, stock price. You haven't lost money because that $1 is in your pocket, right? But for CB investors, they don't have that dollar in their pocket, so they're saying, well, what's going on here? So I buy a call option, and suddenly you pay a whopping big dividend, and then my call price will suffer as a result. So the dividend pass-through is a mechanism, and it's a statement you put in the CB contract that if you are going to pay a dividend, let's say exceeding a certain amount, whatever it is, okay, then I will adjust the call strike price downward as a compensation. Okay, so now if I was to adjust the exercise price down to, let's say 99, let's say I do that. So watch what happens to the call price. It goes back up, well, by a little bit, okay? So you might have to adjust it a bit more because I increased the dividend quite a bit. Okay? Now, as to the question, why does it result in better pricing terms for the issuer? But first of all, what does that mean? Better pricing terms. It means that your CB is now more attractive. So when your CB is more attractive, well, when anything is more attractive, you can sell it at a higher price. Okay? You want to sell your car, so you try to clean it up so it looks sparkling clean and tidy and new. It's more attractive now. So you will get better pricing for it. That's what that means. Okay? So it's better pricing terms for the issuer because your CB is now more attractive because of the dividend pass-through. Okay? Can you please share more on the basis risk related to CNH, CNY? Well, as you know, the CNH market is just the renminbi market that's based in Hong Kong. the CNY market is the one in China. Now, they are approximately the same, but they are not identical, okay? So if you have every time when you have 1 foot in each market and they are not identical, you are going to be running basis risks, okay? So if you pay your investors and it's based on CNH, but you are receiving money overseas in dollars, and these will be converted according to CNY, yes, potentially you have a problem. That's known as basis risk. Okay? Now, let me just pause here for 3 minutes.